Your great financial advisor is here, and in today's tutorial I'm going to be covering tax compliance, general filing of returns, and payment of taxes if any due. Once a person is registered, whether an individual in trade, an enterprise, a partnership, or a trust is registered for tax purposes, there is need for filing of returns, and these returns depends on tax type. Taking income tax as a tax type, and for an individual in business who had just registered, there is need to file the income tax returns on or before the due date. You may ask, what are income tax returns? They are in twofold. Firstly, there is need for quarterly payments where one files the so-called quarterly provisional debt returns, which correspond to quarterly payments which are filed quarterly. Then the final return is filed at the end of the year of assessment, and it is due depending on tax jurisdiction. Taking Zimbabwe, the final tax returns is normally due at the end of the month of April of the following year. And what is the rate of income tax? The rate of income tax depends on jurisdictions, but it varies, and its average is 24 to 25%. Taking Zimbabwe, for example, the rate of income tax is 24%. Then there is AIDS levy of 3%. AIDS levy is applied on the tax of 24%. So 3% of 24% is equal to 0.72%. So the effective rate of income tax for taxpayers in Zimbabwe is 24.72%. Now, the issue of QPDs, the ones that are filed quarterly, these are just payments towards the final tax due for the final tax return. These were made available to make it easy for companies to file their tax returns, and also to reduce the number of defaulters. So in a year we have got 4 quarters. Therefore, as the name implies, quarterly payments dates, we have 4. We have the one which is due 25 March, the second one 25 June, the third one 25 September, and the last one 20 December. And these quarterly payments dates, they are proportions to the total amount of income tax to be paid. We said the effective rate of tax is 24.72%. So during the first quarter, the taxpayer is supposed to pay 10% of that effective rate. It will be due in the first quarter. Then the second quarter, the taxpayer is supposed to pay 25% of the total 24.72%, the effective rate. Then third quarter, you are supposed to pay 30% of 24.72%. Last quarter, you are supposed to pay 35% of 24.72%. You would find if you add the percentages for the quarterly payment dates, they will add up to 100% of 24.72%. Hence, when the final return is due, it will knock off with the payments which would have been made in advance for the QPDs. Once we file our return, what are we supposed to do? We are supposed to pay the corresponding tax due if it's any. You may ask, what happens if one did not trade? Those who would not trade during the year of assessment, it doesn't matter. They are supposed to file returns as long as they are registered for tax with the tax administration. The difference being those who would have even traded during the year of assessment, it implied that the income received during that tax period, it will be zero. so their returns will be just zeros, implying that they had not traded. It should be noted that correct declarations shall be made. Failure to do correct declarations may lead to penalties, severe penalties, as we have alluded in the previous tutorials, that penalties may actually lead a company or an individual and business into insolvency. So due diligence must be taken, as we are supposed to file correct tax returns and pay the correct amount of taxes. Thank you. Remember to like this video, share it and subscribe. Meet you in my next tutorial.